Ay caramba, what a big red day in the markets. Jerome Powell hit the stage with 25 basis points of a rate hike. We're going to talk about that impact and look at some key technical levels in the S&P 500 to watch in today's Stock Market Brief show. I'm Michael Silva. If you haven't done so already, hit that thumbs up. It's greatly appreciated. And subscribe to the channel if you haven't done so already. Let's get into it. All right, everybody. So welcome back. We're looking at the probability of the Fed next rate hike. And you can see here the current target rate for the federal funds rate is 475,500. That's after today's rate hike. And you can see we're sitting here at about a 50% to 49%. This is basically telling us, hey, 49% probability we'll get a 25 basis point hike. And we have just slightly above that it's going to remain flat. So about a 50-50. And if I bring up the probability tools, this is where it gets a little interesting based off today's meeting with Jerome Powell. So as it stands right now, the probability is that we go pause, and then for the remainder of the year into next year, we start to cut. However, there was a person at the press conference that asked a question about, hey, the market is starting to price in rate cuts. Are they right or are they wrong? This is what Jerome Powell had to say about that.
Basically, participants expect relatively low growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
So as you just heard, the baseline expectation is stating that this is actually the wrong way to interpret what they are doing. However, there is uncertainty in the economy. What he stated was, as long as you see that slow growth, inflation coming down gradually, and a rebalance of supply and demand in the labor market, they don't see the need to cut rates like they're kind of showing or pricing into the market. And if that really ends up being the case, that means the market's going to have to reprice markets, the Fed terminal rate being held higher for longer. Remember, their main goal is to bring inflation down to 2%, and we still remain high. So even if they don't continue to raise rates, there's other things that may bring down inflation, such as the tightening that he had mentioned earlier in that press conference. Now, the market today was all over the place. They released the decision. It shot up. It came back down. The Powell conference began. It came down and shot back up. Yellen began speaking, and boom, boom, right? When Powell left the stage, the selling, the blood continued to the low of the trading day. And it begs the question this: the S&P 500 has been holding up rather well in this overall environment, including with this banking crisis that's taking place. So we got to look as to why that is and the potential risks that lie in the S&P 500. First and foremost, financials, right? Financials is a huge portion of the S&P 500. And you can see it got clobbered, and we're sitting right around lows since the start of that crisis. And you can see KRE is a very similar type look. And then energy was also one that took a big hit to the downside as this started. Now we had a little bit of a bounce, but it's coming back into the 200-day moving average and this prior area of support, which can held as resistance. Now, these are two big sectors, and that's going to put a drag on the S&P 500. So one might think, well, why isn't the S&P 500 going down? That's because of technology. Technology stocks has been this kind of flight to safety in recent trade. So as this market moves higher, it's really stabilizing the S&P 500. And if I take a look at the heat map today, even the big names like Microsoft and Apple, they fared pretty well. And if you take a look at the financials, you can see Bank of America just, completely got hit. Schwab, 5.4% down. And then even these big energy names, XOM and CVX, those were down over 2% there too as well. So we had some clobbering, but yet the big tech names, they fared okay. Now this is where it can get a little dangerous. What happens if these financials remain down, right? And they don't really get a relief bounce. They just stay down or go down lower, and energy does the same thing, and then tech gets hit. That's where the S&P 500 can have some big problems. In yesterday's show, we talked about the zones. Here are the updated zones. We had mentioned the dollar. We had mentioned Qs. The dollar took a big hit today, also when Yellen started talking. The Qs, however, we were bright red. That means, if you're new here, this is just an indicator that I share here on my Discord. My Discord, if you want to join it, you can do through Patreon and then sync Discord to it. It's $9 a month. It's very inexpensive. And if you don't want to pay monthly, I don't blame you. Just do the year. It's $90, so you get a discount. Okay, so the Q's backed off, right? So now it's like gray status. If I go to this slide, this was what the zones looked like yesterday, and we had mentioned, hey, you know, don't be FOMO'd into this rally right now, because all the megas, right, in the S&P 100, S&P 500, they're nearing overbought conditions where the high level of this is, and right, and this is like fractal, like a fractal indicator, okay, using math from Benoit Mandelbrot. Now, as seeing this, and we saw like the upsides minimize and where price closed, and then the downsides were getting pretty heavy, it basically said, hey, you know, take your foot off the gas here, make sure that you're using, you know, best risk management. And we said the possibility of this backing off, we had to be well aware of. And now what did we see happen? So they didn't take a huge hit altogether, but you can see they started backing off here. So the downside has been minimizing as price came down a little bit. But one thing to note is the majority of these, if not all of them, they're above their midpoint at this current time. And the midpoint can act like somewhat of an average or a moving average. I mean, it's nothing like a moving average, but we'll just call it that. So when it's trending up and price is above it, you know, it can act as a potential level of support. So if this starts breaking, these closes start closing beneath that, that could be quite bearish. Okay. Now I want to call out Nvidia, because Nvidia is still in the red. This is one of the things that I shared also in the Discord today or tonight, and I'll just talk about this here. Nvidia had a pretty key reversal intraday, creating what's known as a daily shooting star candle. Now, the shooting star candle can potentially mark a change in trend, or the start of a change in trend. I say potential change in trend because you need to have follow through. So as long as price doesn't get back above and close above that high of the day, which was 275.89, then this is still intact. But this was a pretty large kind of blow off move and completely reversed on high volume. And then to note, we have a negative divergence on the RSI, and also to note we're in this band of prior resistance. It was resistance here, and it also held as support here. And then when we broke down, we saw that big flush down. Okay. So if Nvidia starts getting tagged and starts moving lower, it could very well affect some of these other names here in the megas. Nvidia, remember, it's one of the top 10 stocks in the S&P 500, which is a cap-weighted index. So if Nvidia starts coming off and backing off, and we don't get any relief in financials or energy, well, that could pose a threat to the S&P 500, and we need to be aware of that. So we'll talk about, hey, what do we need to see in order to feel a lot more confident? Well, first and foremost, we felt confident yesterday, but we were a little, not afraid, but we were a little concerned with the recent FOMO. And you can see that because we got above that year-to-date anchored VWAP. Today, we saw a nice little move up higher, but there was no confirmation really on the daily close, clearly. And then we started heading lower. So we're now back below the year-to-date anchored VWAP. So what you want to see is that reclaimed. To be more bullish, you want that reclaimed, and you want price to get, we want the anchored VWAP to start turning back up. Okay, we also close beneath the anchored VWAP right from here, which is, I believe, the month to date. So we're back below that one too as well. And you can see it a lot better here on the 15-minute time frame. So if we take a look at the 15-minute time frame, I'll call this out right now. If you are bullish, be cautious. If you are bearish, you also got to be cautious, but the bears do currently have control. Why? Well, they're below the week-to-date anchored VWAP. Sorry, the month-to-date. They're below the week-to-date there too as well, and they regained control of the 5-day moving average. Now, the 5-day moving average, it's inclining, but if price reflexes, bounces here, remember, it can start turning back around, and it can act as a potential area of resistance. That would be some sort of a bear flag back down to where that daily expected move, okay? That would be around that time, and I'll show you the RSI and stuff here momentarily. One thing to call out, yes, we came in right to the weekly expected move. It got rejected right at about the same time Janet Yellen was talking. We came into the week-to-date anchored VWAP. We bounced from it into where? This white line. What's that white line? That is the JWAP. What is the JWAP, Michael? That's the Jerome weighted average price. So we had obviously a key macro data drop, okay? And this is important to anchor to see where the average price or the average buyer based on volume is. Are they above water or are they underwater? So any buyer since that point would technically be underwater. Why? Because the price is down here and the anchored VWAP is right here. So to be more bullish in these shorter term time frames, yeah, you can play bounces and such, but you want to see price reclaim the JWAP, and you want to see that start turning back up again as well. So it's a time to be very cautious here. Like I said, I chose to stand on the sidelines and just watch how price action unfolded today, because it was just too wild overall. If I show you the RSI on that 15-minute time frame, we're moving into that oversold condition, which means we can have a potential rubber band bounce, but that doesn't mean that anything has been fixed. PMO is pointing straight down, still above that zero marker there too as well. I like to show bookmap levels on here for the S&P 500, but ES, and this was yesterday's chart, and we mapped out some key levels, the upper EM and this 40-80 kind of node right here of liquidity, and then below us we had that 39.95 level of liquidity and the lower EM. So what happened with price? Oh, and we also had that 40-50 level, that key level too. So you can see 40-50 was right here. Okay, in the day we came up, it acted as resistance, we broke up through it, boom, we broke up higher. And what happened to be, where did that happen to be? Where that node of kind of supply was, that liquidity. And that also happened to be right by the weekly expected move. And then you can see we got rejected, never back up to the daily expected move, but as we got rejected and back tested the daily VWAP, look where price crashed down into and closed, the lower expected move. This is the level that the market priced in the prior trading day. This is why it's so important to understand these expected moves, because it gives you a really good idea as far as forward-looking risk in the markets. Speaking of forward-looking risk, what can we potentially look into tomorrow? Okay, so the upper expected move for tomorrow on ES is about 40.25, and then the lower expected move is down here at about, I'm just going to say 39.30. If you want the exact levels, I posted them on the Discord, and I may show a screenshot on Twitter there. You can follow me on Twitter, and I'll try to get that up tonight. Couple other interesting areas of liquidity to pay attention to. It's right up here, just above the upper expected move, and then it's right here below the lower expected move, where there's quite a bit of contracts out there hiding out there too as well. So we'll see how price action responds in these areas. It could act as a potential area of support, could act as a potential area of resistance, but those is what the market, as far as looking forward into tomorrow, it's pricing in for risk. And if you think of this as, you know, a bell curve, right? A bell curve, that's a horrible bell curve. I'm just going to draw a smiley face now. Yay. Okay, if you think of this as a bell curve, one standard deviation is right here, and that's 68% of the time. So basically, if you're dealing with probabilities here, 68% of the time in the S&P 500, price is going to close within this range. So it creates opportunities if we get outside of it, or if we near it, or if we start to see price trending, where you can potentially play into those kind of levels of liquidity and also those expected moves. That's all I got for you on today's show, everybody. Have a wonderful night.